Welcome back to the deep dive. Today, we are really getting into something fascinating. The 2011 Shareholders letter from Fairfax Financial Holdings.
Yeah, it's a remarkable document because 2011, I mean, what a year. Just absolute chaos globally, right? You had unprecedented natural disasters, massive market volatility.
Exactly. And that's the paradox we want to unpack. How does this huge insurance and investment firm navigate just record short-term losses
Huge losses.
while sticking to their guns on long-term value investing and, prepping for these big macroeconomic threats they saw coming in Europe, the US, China?
That's the mission, all right. It's about
Uh,
looking at how they handled, well, literal devastation while keeping their focus years, even decades down the road. The immediate hit, though, it was pretty brutal.
Yeah, let's start there. The immediate shock, what did it look like financially?
Well, if you look right at the numbers, their book value per share basically went nowhere. It actually dipped slightly from $376 down to $365.
Yeah, but then they paid out a big dividend, right? Like
Yeah,
$10 a share.
that's right, a $10 common share dividend. So despite that payout, book value was essentially flat. And shareholders' equity, the overall equity base, dropped from $7.7 million down to $7.4 billion.
And the driver for that flatness, that pressure, was these insane catastrophe losses hitting the whole industry.
The whole industry got hammered. 2011 saw over $105 billion in insured catastrophe claims globally. That was, well, the worst year ever at that point, apart from 2005.
2005, Katrina, Rita, Wilma, yeah.
Yeah, exactly. So second worst year on record. And for Fairfax specifically, it was their worst year ever for catastrophe claims.
How bad we talking for them?
About $1 billion.
Yeah.
Roughly $1 billion in cat claims hit their books in 2011 alone.
$1 billion. Wow. Can you break that down? What were the big events?
Oh, the list is just grim. The biggest single event was the Tohoku earthquake and tsunami in Japan. That cost Fairfax $470 million.
Almost $500 million from one event.
Yeah. Then you had the terrible floods in Thailand. That was another $202 million. U.S. tornadoes added $70 million. The earthquake in New Zealand, $63 million. And Hurricane Irene tacked on another $31 million. Just relentless.
So how did that translate into their key insurance metric, the combined ratio?
Right. So the combined ratio tells you if the underwriting was profitable. These losses blew a huge hole in it. They added 19.3 percentage points to the combined ratio.
19 points, when they normally expect, what, maybe 6 points from cats in an average year?
Exactly. So that massive hit pushed their consolidated combined ratio for 2011 all the way up to 114.2%.
Okay, 114.2%. Let's just spell that out for the listener. Over 100 means.
It means for every dollar they collected in premiums, they paid out about $1.14 in claims and expenses. So the core insurance operation lost money that year, a significant underwriting loss.
Which puts all the pressure on the investment side to make up for it, and then some.
Absolutely. The whole model relies on the investments generating returns greater than that underwriting loss over the long haul.
Now, the letter says their goal is basically to manage cat exposure, so losses don't wipe out their expected income for the year. And they just barely managed that in 2011.
They did. They thread the needle. But, that raises the question. You see other insurance companies get totally wiped out by single events. They mentioned 20th Century Insurance after the Northridge quake.
Right, lost 30 years of earnings in one go.
Yeah, and Tyree, basically the same thing happened to them with the 2011 floods. So seeing that carnage, why would Fairfax want more exposure to this kind of risk? Why lean into it?
It seems counterintuitive. Run away, don't run towards the fire.
Well, their view is that if you manage the risk properly and you're capitalized correctly, it's actually a very profitable business over the long term. These disasters, sadly, also create opportunities.
Like with Tyree, they didn't just note the disaster, they invested.
Exactly. Out of that chaos, they saw a chance. They invested $70 million for a 25% stake in Tyree after it had been hit so hard, helping recapitalize it. They were excited to partner with the existing management team there. It's a classic long-term contrarian move.
Okay, so they believe in the long game. Do they have proof from their own operations that this high-risk stuff pays off over time?
They do. They point to Odyssey Re, which is their biggest single source of catastrophe risk.
Okay.
And they show over the 12 years from 2000 to 2011, a period that included 9/11, Katrina, Rita, Wilma, and all the 2011 disasters we just listed.
A brutal stretch.
Absolute. Despite all that, Odyssey Re achieved a cumulative combined ratio of 96.7% over that entire period.
So under 100, meaning profitable underwriting over the full cycle.
Precisely. Writing $7 billion in property premium during that time and still coming out profitable on the insurance side, despite those massive, massive loss years. It validates the strategy, they argue.
And this long-term view connects to their operational discipline too, right? They weren't chasing premiums in 2011.
No, quite the opposite. They mentioned they were operating with huge amounts of unused capacity, writing business at only 0.67 times policyholder surplus.
Okay, policyholder surplus, that's basically their capital cushion, the reserves backing the policies.
Exactly. It's the net worth of the insurance company, essentially. And they could, in theory, write business at maybe 1.5 times that surplus, maybe even higher in a really hard market where prices are high.
But they were at 0.67, so they were deliberately holding back.
Very deliberately, they were waiting for insurance prices to rise significantly, which they expected would happen because of the massive 2011 industry losses and the continuing pressure from record low interest rates on investment income. Patience.
Patience seems to be the watchword here, which is a good transition to the investment side, because value investing requires that same patience, especially as they mentioned with things like mark-to-market accounting messing with the short-term picture.
Oh, absolutely. The IFRS mark-to-market rules really made and still make reported results incredibly volatile, or lumpy, as they call it.
so.
Because unrealized gains and losses on their stocks and bonds, basically paper profits or losses, flow directly through the income statement each quarter, each year, even if they haven't sold anything.
So the reported profit can swing wildly based on market fluctuations, even if the underlying business or asset hasn't really changed much in terms of its long-term value.
Exactly, it creates noise. And they give a great example with their Bank of Ireland investment.
Oh, yes. Bank of Ireland. What happened there?
Well, they bought shares at 10 cents per share, but at the end of 2011, the market price was down, and they had to mark it on their books at 8.3 cents.
So on paper, an instant loss.
Right. Looks bad on the year-end statement. But they knew the underlying value case. And sure enough, just a few months later, in early 2012, the stock was trading back up at 15 cents.
So the accounting showed a loss, but the reality was quite different very quickly. It highlights the disconnect.
It perfectly illustrates why they preach, ignoring that short-term market noise and focusing on intrinsic value. Patience again.
And that patience really paid off with another investment they detail, International Coal. They didn't just buy and hold, they actively managed it.
They did. It's a fantastic case study in averaging down. Their initial cost was around $4.58 per share. The price went down, and they bought more, averaging their cost down to $3.37 per share.
Buying more as the price fell requires conviction.
It does. And then it paid off spectacularly.
Yeah.
They sold about half their position at $7.26 per share.
Nice profit.
A very nice profit. But then the rest of their holding got a takeover offer at $14.60 per share, double their initial selling price.
Wow. So the total gain must have been huge.
Huge. A $341.2 million realized gain on that one investment. It's textbook value investing. Buy cheap, buy more if it gets cheaper, assuming the thesis holds, and then sell much higher. Be greedy when others are fearful, and average up when selling too.
So beyond stocks, they were also making strategic investments, sometimes in unexpected places, like that Kennedy Wilson deal.
Yeah, that one apparently came about from a meeting at a Berkshire Hathaway annual meeting. They invested first in preferred convertible shares.
Okay.
And then later partnered with Kennedy Wilson on about $290 million worth of real estate deals, buying distressed assets, things like office buildings and apartments in California, Japan, and the UK, aiming for deep discounts to what it would cost to build them new.
Right, classic distressed investing. But then they also bought, let me get this right, a fine China retailer, William Ashley, and a sporting goods store, Sporting Life.
Yep. William Ashley, a 64-year-old Toronto institution.
Yeah.
And 75% of Sporting Life, which is a high-end sports retailer.
That seems really different. How does buying a China shop fit into a global insurance and investment company's strategy? They even say they plan to keep them forever, like family.
It's definitely different from trading stocks or buying distressed debt. The idea here, as they explain it, is these are stable, cash-generating businesses run by good people, often the founders. They see them as permanent homes for capital, generating reliable free cash flow completely outside the volatile public markets.
So diversification into steady private businesses. Less lumpiness.
Kind of. It's part of their overall structure. Decentralized operations, letting good managers run their businesses. They call it the Fairfax family. Less about quarterly earnings, more about long-term, steady cash generation.
Okay, so they're making these patient, long-term moves. But paradoxically, the letter shows they were incredibly worried about the near-term global economy. They kept a full 100% equity hedge in place.
They were very bearish, near term. despite being structurally bullish on their specific investments long term. That hedge means for every dollar of stocks they owned, they essentially had a short position betting the overall market would fall.
Why so negative? What were they seeing?
They laid out a pretty stark case. They believed the U.S., and potentially the West more broadly, was facing maybe a decade of really slow growth or even deflation, sort of like the U.S. in the 1930s or Japan since the 1990s.
A lost decade scenario.
Basically, yeah.
Yeah.
They felt governments had used up all their stimulus firepower in the 2008 crisis and didn't have much left in the tank.
And they pointed to specific global risks that backed up this view, starting with Europe.
Oh, yeah. Europe was flashing major warning signs for them. Just extreme leverage in the banking system. Bank assets were something like 2.6 times the entire GDP of the Eurozone.
Whoa!
Yeah, just massive. They highlighted France, where bank assets were $9 trillion against a GDP of only $2.7 trillion. And on top of that leverage, there was the very real risk that the euro itself could actually break apart. Huge systemic risk.
Okay, so Europe was one trouble spot. What else?
China. They were very concerned about China. They saw their real estate bubble there clearly starting to burst in late 2011.
How could they tell?
Developers are being forced to cut prices, sometimes by 25% or more, in major cities just to move inventory. Fairfax expected apartment prices could fall significantly more, leading to potentially a really nasty hard landing for the Chinese economy, which would ripple globally.
And any other specific worries?
They also flagged commodity prices. The huge run-up in commodities had stalled out in 2011. Cotton prices, for example, fell 37%. They saw that as another potential sign of broader economic weakness ahead.
And closer to home for them in Canada.
Canada wasn't immune. They specifically called out concerns about a housing bubble, especially in Toronto and Vancouver, which had been fueled by that same commodity boom. Lots of risk factors swirling.
Given all that negativity, that fear of deflation, it leads to one of the most unusual parts of their portfolio back then, the deflation hedges.
Right. This was pretty unique. They held large positions in CPI-linked derivative contracts. The total notional amount was massive, $46.5 billion.
$46.5 billion. What exactly were these contracts? Insurance against falling prices.
Essentially, yes. Insurance against deflation. If the Consumer Price Index, CPI, went down significantly over the average 8.6-year term of these contracts, Fairfax would get a payout. They pointed to the cumulative deflation seen in Japan for decades and in the U.S. back in the 1930s as the kind of scenario they were insuring against.
A low-probability, high-impact event they wanted protection from.
Exactly. Low-cost insurance against what they saw as a plausible, if not probable, tail risk.
And finally, within that bearish outlook, they made a big move in their bond portfolio too, right? Selling off long treasuries.
They did. They sold about half of their long-term U.S. Treasury bonds, realizing a $271 million gain in the process.
Why sell if they were worried about the economy? Aren't treasuries usually a safe haven?
They are. But Fairfax felt the multi-decade bull run in bonds was basically over. Interest rates had fallen so far for so long, they believed rates simply couldn't go much lower to provide those kinds of high returns anymore. They actually said the game is over for long treasuries.
So locking in gains and getting out before a potential reversal.
That seems to be the thinking. They even signaled they'd likely sell the rest soon, shifting away from an asset class they thought had run its course.
Okay, so wrapping up 2011, it's this incredible mix. Record insurance losses, accounting volatility, making things look even worse, short-term, deep macroeconomic worries.
A real crucible, as you said.
Yeah. But through it all, they stuck to their long-term discipline, both in insurance underwriting and value investing.
And if you bring it back to the shareholder, or just someone studying the company, the letter really emphasizes the underlying financial power. They talk about the float.
Right, the float. That's the insurance premiums they hold and invest before paying claims.
Exactly. It's essentially free money to invest if your underwriting is profitable over time.
Yeah.
At the end of 2011, Fairfax had about $707 per share in float.
$707 per share. That's significant.
Gary. And when you add that float to the actual book value per share, which was $365, and then adjust for some net debt,
Yeah.
you get roughly $1,194 in total investments per share working for the shareholder.
Almost $1,200 per share in investment firepower. That's the engine.
That's the long-term engine. And it leads to, I think, a really provocative final thought they leave you with in these letters.
Oh, yeah. What's that?
Well, they point out that over their history, up to that point, 26 years, the company's book value per share had compounded at about 23.5% per year.
Mm.
Phenomenal. And the stock price, It compounded at around 20.7%. Pretty similar rates over the long haul.
Okay, so long-term book value growth drives stock price growth. Makes sense.
Right. But they explicitly state that on a year-to-year basis, there is no correlation whatsoever between the change in book value and the change in the stock price. None.
No correlation year to year, but strong correlation long-term.
That's
Doesn't
crucial. It raises the fundamental question for any long-term investor. How do you train yourself? How do you get the mental fortitude to completely ignore the daily, monthly, even yearly swings in the stock price? To ignore the panic of a year like 2011, the scary headlines, the mark-to-market losses,
Okay.
or at least believe that the underlying intrinsic value is compounding away steadily underneath all that noise. Exactly. That's the challenge. Can you ignore the volatile stock quote when the real value is growing reliably over decades? Yeah. This whole deep dive into 2011, I think, shows just how hard that is, but also why it's so necessary for long-term success. Patience isn't just a virtue. It's maybe the